So, looking at the American consumer right now, like as of late July 2026, the spending data actually looks like an absolute party.
Oh, totally. I mean, people are out there buying light-duty trucks. They're, redecorating their living rooms, new furniture.
Right, and they're just completely shrugging off those higher prices at the pump.
Yeah. Consumer spending actually just accelerated. It grew at a really robust 3.2% in the second quarter.
Which is wild, right? Because if you only looked at the mall or the dealership lot, you'd assume the economy was just firing on all cylinders.
You would. But, you have to zoom out to the broader macroeconomic picture. And when you do that, the economy is quietly slamming on the brakes.
Yeah, that surprise report from the US Commerce Department.
Exactly. They just reported a surprise slowdown in second quarter GDP growth, dropping down to 1.5%.
Which is a pretty sharp decline from the 2.1% we saw in the first quarter, right?
Yeah, and it completely missed analyst expectations. Everyone was basically looking for a steady 2%.
So we have this weird contradiction, a booming consumer, but a really sluggish gross domestic product.
Right. And that highlights this massive underlying friction in the market right now.
Because that headline GDP slowdown that was mostly driven by lower government spending and like this sudden pullback in business investment, right?
Exactly. Companies are super hesitant to allocate capital right now. And it's not because there's a lack of consumer demand.
Right. They have the customers.
We have the customers, but the basic, infrastructure of doing business has just become wildly unpredictable.
Yeah, the physical and the digital systems they rely on, they're suddenly requiring these massive unexpected investments just to keep the lights on.
Just to maintain the status quo.
It's like, I was thinking about it like this. The global economy used to operate like this perfectly timed conveyor
Oh,
belt.
what I got that.
You placed an order, the belt hummed to life, and boom, a product arrived at your door predictably, cheaply, and with zero drama.
Right. But as of late July 2026, that build just keeps abruptly stopping,
Exactly. And to keep goods moving, businesses are basically having to build their own expensive makeshift belts on the fly.
which creates this huge hidden tax on the entire system. I mean, the central financial story playing out right now isn't just some basic debate about inflation.
Or, whether the Fed will hold interest rates steady again.
Right. It's about how companies across the globe are aggressively rewiring how they operate. They have to handle this highly volatile world.
And most importantly, who actually ends up footing the bill for all this new resilience?
Right, because geopolitical volatility is forcing structural market changes we just haven't seen in decades. Maritime trade is probably the prime example of this.
Yeah, let's get into the maritime stuff because roughly 80% of global merchandise trade by volume moves by sea.
80%. And the entire global supply chain just assumes those oceans are safe and, free to navigate.
But key choke points like the Strait of Hormuz and the Black Sea, they've become these active, sustained battlegrounds.
We've basically entered a new era of maritime warfare, and it's being conducted almost entirely with cheap drones and missiles.
Which completely messes up the math. I mean, a small, decentralized force can deploy, what, a $2,000 drone?
Yeah, a cheap drone,
Mm.
and it can effectively threaten a $100 million cargo ship.
Let's unpack the underwriting math on that asymmetry, because the financial ripple effect there is just staggering.
It really is. Historically, maritime insurance models relied on like centuries of actuarial data.
Yeah.
Weather patterns, shipping lanes, traditional piracy.
So an underwriter could calculate the exact risk of moving a container from point A to point B.
Exactly. But how do you build a risk model for unpredictable, cheap drone warfare?
You can't.
You can't. Insurance premiums for going through these conflict zones have absolutely skyrocketed.
Because the disruption is so cheap for an adversary to sustain, but mathematically impossible for the underwriter to price accurately.
Right, so the insurer just has to assume the worst-case scenario.
Yeah.
And they pass that massive premium straight on to the shipping company.
And supply chain leaders are looking at these skyrocketing premiums and the constant threat of disruption, and they're just giving up on the old way.
Yeah, they're officially abandoning the decades-old assumption of free and safe shipping. They aren't waiting for a diplomatic resolution to just magically fix the transit map.
They're pouring actual capital into permanent, costly alternative architecture now.
Huge amounts of capital. Logistics giants are building new overland freight corridors. They're investing heavily in bypass pipelines for energy and paying premium rates for forward storage.
Which basically means hoarding inventory closer to their markets just in case the ships stop moving entirely.
Exactly. And the financial winners in this kind of chaotic environment are the entities built specifically to capitalize on wild price swings.
Like Shell. Let's look at Shell's second quarter earnings that came out earlier this week.
Yeah, their profits more than doubled. They hit $9.84 billion.
But wait, Brent crude oil has been hovering around like a relatively stable $90 a barrel as of late July. So Shell didn't make this money simply because oil was exceptionally expensive everywhere.
No, the secret to those bumper profits was actually their trading desk.
Oh, okay.
When a vital choke point like the Strait of Hormuz faces a sudden disruption, oil prices spike and drop violently, like hour by hour.
And those massive fluctuations widen the spread between buying and selling prices.
Exactly, which allows sophisticated traders to extract massive margins just from the sheer panic in the market.
Wow. And this global shift in energy architecture, it's completely transforming local economies, too.
Oh yeah, you can see the physical manifestation of this transition in Cameron Parish, Louisiana.
Right, because back in 2005, Hurricane Rita essentially wiped that coastal county off the map.
But fast forward to the summer of 2026, and it has transformed into this booming liquefied natural gas, or LNG, export superpower.
It's home to the massive Sabine Pass terminal and the new $13 billion Commonwealth LNG project.
13 billion, yeah.
Yeah.
And the U.S. now supplies roughly two-thirds of Europe's natural gas imports.
Which is a huge shift. And European nations are aggressively buying this American LNG, not because it's the cheapest option on the market, right?
Not at all. It's
Yep.
purely for the security of the supply line. They are prioritizing geographic dependability over cost.
But the cost disparity of that geographic security is just staggering. It's completely changing the math for European industry.
Oh, absolutely. Natural gas in the U.S. is just a fraction of the price it is in Europe.
Look at the Infralamuna Chemical Park. It's
Yeah.
this massive manufacturing site in central Germany that makes base chemicals for, countless consumer goods.
Right. Before the major supply chain disruptions in Eastern Europe, their annual gas bill was roughly $68 million.
Okay, 68 million.
But amid the ongoing conflict in the Middle East and this huge pivot to American LNG, that exact same gas bill is expected to exceed $225 million this year.
Wait, from 68 million to over 225 million just for gas?
Yes. Yeah. German manufacturers are paying an enormous premium just to ensure the lights stay on and the industrial machines keep running.
Which really makes you wonder, does this mean the entire concept of efficiency is officially dead?
I mean, for the last 40 years, global business was just this relentless race to the bottom line, right?
Finding the absolute cheapest way to make and move a product, relying on just-in-time manufacturing, single-source overseas suppliers.
But if a German chemical plant is willingly paying triple for natural gas just because the American supply chain doesn't run through a war zone,
Then the era of optimizing solely for the lowest cost is just over.
it's over. And that premium for certainty, it doesn't just evaporate in the accounting department.
Right. It gets baked into the cost of every plastic casing, every synthetic fabric, every chemical fertilizer produced at that facility.
Which brings us to the ground level, because that margin crush, the rising cost of keeping basic systems running, is trickling all the way down.
It's hitting the agricultural sector incredibly hard. We're seeing this acutely in the food supply chain, where the rising cost of basic inputs is just squeezing producers from every angle.
Yeah, look at the bizarre market dynamic happening in the UK right now. Analysts are literally calling it burgerflation.
Burgerflation. Okay, so British consumers are currently paying 9% more for beef and 8% more for vegetables compared to this time last year.
But here's the cash in boat. The local farmers raising that cattle are receiving 8% less for their beef.
Wait, consumers pay 9% more, but farmers get 8% less. Where exactly is that money vanishing to?
That is the big question. Because if the consumer pays more at the register, but the farmer takes home less, there is a massive intermediary layer capturing that capital.
The middlemen, so logistics companies, energy providers, food processors.
Yeah, they're acting like a giant sponge, just soaking up all the retail price increases before a single cent ever reaches the actual agricultural producer.
Right. Like consider a local baker in York. Retail bread prices on the shelf are up slightly, maybe 2%, but the local wheat farmers are getting paid less per ton.
Because the baker is being forced to absorb massive commercial rent hikes, surging delivery fuel costs, and increased national insurance contributions just to meet payroll.
So that extra money you pay for a loaf of bread, it's entirely consumed by the increased friction of merely operating the bakery and delivering the product.
Exactly. And the American Midwest is facing the exact same squeeze.
Which really tears down that common consumer assumption that high grocery prices automatically mean farmers are, getting rich?
They're definitely not getting rich. Iowa farmers are dealing with a brutal combination of persistently high diesel and fertilizer costs.
And those are inputs directly exacerbated by the ongoing tensions involving Iran and global energy disruption.
Right. And at the exact same time, those farmers are suffering from lost export markets due to renewed global tariff battles.
Because when retaliatory tariffs are placed on American agricultural exports, international buyers just naturally pivot to cheaper, frictionless markets like Brazil or Argentina.
Leaving the American farmer with surplus crops and a shrinking pool of buyers, right when their cost to produce that crop is at record highs.
It's a brutal trap, and the financial strain on the agricultural economy is severe. It's compounding.
Projections from the American Farm Bureau Federation indicate that crop losses for major U.S. farmers could hit $32 billion by 2027.
$32 billion.
Yeah. We're watching the agricultural sector deal with highly volatile production costs and a complete lack of predictable access to international buyers.
The margin that used to sustain these rural economies is being eaten entirely by the rising cost of fuel, specialized fertilizer, and international shipping friction.
It's a heavy, heavy toll.
When looking at a $32 billion projection in crop losses, the sheer physical strain on the economy is just a lot to process.
Oh, for sure.
And if your brain needs a brief mental detour from global supply chains and margin crushes, you can actually find financial candy, brain candy, and classic audiobooks over at claireandhoratio.com.
A very necessary break. But returning to those structural limits, this bottleneck isn't just restricted to the movement of physical goods like wheat and oil.
Right. The digital world is slamming into its own hard physical wall right now.
We tend to think of the internet and artificial intelligence as these invisible, weightless things floating in the ether, but, the cloud is just someone else's computer.
And those computers are made of highly specialized metal. They require vast amounts of land, and they consume massive, massive amounts of electricity.
Which perfectly illustrates the earnings report we saw from Meta earlier this week.
Yeah, let's talk about Meta, because they have a highly profitable, very solid core advertising business.
They do. But despite that, their shares slid in extended trading following the report.
Because the market reacted negatively when Meta drastically raised the lower end of their capital expenditure guidance, right?
Yes. They are now expecting to spend between $130 billion and $145 billion for the full year of 2026.
That number is just mind-blowing, $145 billion.
Wall Street is genuinely terrified by this seemingly endless appetite for artificial intelligence compute spending.
Because the reliable free cash flow that tech investors used to love, it's just evaporating into the physical infrastructure required to build the AI cloud.
Right. And what exactly does $145 billion in capital expenditure actually buy you in the AI arms race?
It buys silicon, cooling systems, and memory chips.
And the physical hardware required to build this infrastructure is getting significantly more expensive.
Qualcomm, a major chip maker, just announced they're raising their chip prices starting September 1st.
And they didn't just cite unprecedented demand as the sole reason. They specifically cited a broad-based increase in their own input costs.
Especially cost of memory components, yeah.
So the cost of entry to even participate in the AI race is going up across the entire tech supply chain.
But the power constraints are even more immediate and dramatic than the rising hardware costs.
Oh, absolutely. I mean, training a next-generation AI model requires thousands of advanced processors running at full capacity for months at a time.
Generating immense heat and drawing staggering amounts of wattage.
Which leads us to the bizarre situation developing with XAI down in Memphis, Tennessee right now.
Okay, this story is wild. To power their massive new AI data centers, they've actually resorted to trucking in off-grid, unpermitted gas turbines.
Unpermitted gas turbines. And now state and federal regulators, including the Department of Justice, are battling over the legality and the environmental impact of this.
Because tech companies are discovering that local municipal power grids simply cannot handle the sheer electrical load required by these new facilities.
Which really forces the question, with tech companies resorting to trucking in makeshift gas turbines just to get enough juice to run their servers, are we watching an AI infrastructure bubble ready to burst?
Or is this simply the brutal new cost of entry? I mean, if securing electricity requires fighting the DOJ over unpermitted generators, the capital required to stay competitive is going to lock out almost everyone.
Everyone except the wealthiest mega corporations.
Exactly. And it ties perfectly back to our look at the energy markets earlier, whether it's navigating a cargo ship through the Strait of Hormuz or powering a data center in Memphis.
Securing reliable power and transit is rapidly becoming the dominant cost of doing business.
So, with all these rising costs stacking up behind the scenes, from maritime shipping insurance to specialized agricultural fertilizer to next generation memory chips, the ultimate test is the consumer.
Right. How are consumer-facing brands navigating this environment? Because the second quarter results show a sharply divided consumer base.
Let's look at Procter & Gamble. Their recent Q4 earnings report serves as a major warning sign for the broader retail market.
Yeah, as their organic sales volume was completely flat.
In the post-pandemic period, P&G relied almost entirely on lazy across-the-board price hikes to grow their revenue.
They just passed every ounce of supply chain friction directly to the shopper. But now, consumers are finally pushing back.
Shoppers are actively stretching out their Tide detergent, using a little less per laundry load. Or they're abandoning premium brands altogether and trading down to cheaper store labels.
So P&G is now being forced to abandon their pure price hike strategy and pivot back to a balanced operational model to try and win back that lost volume.
Companies can no longer rely on blindly passing costs to the consumer without consequence. But contrast P&G's current struggles with Starbucks.
Right. Starbucks delivered an absolute home run third quarter.
Under CEO Brian Niccol, they navigated the exact same inflationary environment, but they took a fundamentally different approach.
They didn't just jack up the price of a latte and hope their customers remain loyal. They focus heavily on fixing operational bottlenecks inside their stores.
Which was a huge issue. They hired more workers to eliminate those long wait times that had been causing frustrated customers to just abandon their mobile orders.
And more importantly, they created entirely new revenue habits by driving afternoon store traffic with new energy refreshers.
And they pushed high food attachment rates, right? Successfully enticing people to buy a breakfast wrap or a pastry alongside their drink.
They earned the consumers' increasingly stretched dollars by actually removing the friction from the customer experience.
But then you have brands operating in a totally different economic reality, entirely insulated from this ground-level margin crush, like Ferrari.
Ferrari just reported a massive earnings beat, and they actually bumped up their 2026 financial guidance.
They're boasting incredibly high global demand, a surge in highly profitable, expensive custom vehicle modifications.
And an order book that is completely full all the way through the end of 2027.
Because they cater to a demographic that is entirely unaffected by the rising cost of groceries, the price of gasoline, or the uncertainty surrounding interest rates.
So the underlying market lesson here is incredibly stark for any business operating today.
You either have to be selling to the ultra-rich, like Ferrari, where price elasticity essentially just doesn't exist,
Or you have to relentlessly optimize the operational experience like Starbucks.
if you sit in the middle and simply try to pass your rising logistics and energy costs onto the average consumer without improving the core product, you end up exactly like Procter & Gamble.
You'll just watch your sales volume stagnate as regular people find creative ways to make do with less.
So, synthesizing this broader pattern across all the financial stories from late July 2026, we are not looking at a single apocalyptic global collapse.
No, the economy isn't breaking, it's adapting. We're witnessing a massive historical repricing of certainty.
The entire era of cheap and assumed infrastructure is officially behind us. Securing a safe shipping lane now costs a premium in insurance and fuel.
Sourcing reliable electricity for an artificial intelligence data center requires unprecedented capital and off-grid workarounds.
And maintaining a profit margin on a simple beef burger means fighting a grueling daily battle against logistics and energy costs.
The global economy is frantically building redundancies into the system, and those redundancies carry a hefty price tag.
And as major companies inevitably bake the high cost of this redundancy and physical resilience into their long-term business models, you, the consumer, will ultimately pay for that macroeconomic safety net.
Right. The friction in the system eventually trickles down to the final price tag on the shelf, the cost of a digital subscription, or the price of a gallon of gas.
Which really forces a very practical look at your own financial exposure.
Yeah, absolutely.
Look at your own household or business budget this week. Where are you currently relying on cheap and assumed systems, whether that's historically low property insurance, predictably cheap household energy, or inexpensive digital cloud storage?
You have to consider which of those systems might soon require a costly backup plan, as the companies providing them are forced to reprice their own certainty.
The global conveyor belt might still be moving, but the toll to keep your everyday items riding on it is only going up. Stay curious, keep watching those underlying mechanisms, and we will pet you next time.